Hello, we're FKD Shoes, and this is our presentation on the Business Strategy Game Online for Management Class 4388 Online. The co-managers are Derek Majek and me, Kevin Satterwhite. So our strategic vision is that FKD will offer quality footwear at an affordable price anywhere in the world. We will do so while ensuring that we are leaders in demonstrating corporate social responsibility, while also providing excellent products to our current and future customers. So the strategic group map for the North American wholesale segment in year 11, at the beginning of the simulation, we were all kind of in the same roundabout place with a few exceptions here. Our team began by starting to build up our plant in Europe because of the favorable exchange rates at the time, and also we purchased new equipment there as well, due to the fact that the refurbished ones was only good for 5 years. This plus a few other modifications resulted in higher than investor expectations for our share prices and our earnings. In the wholesale division in North America, we started with low prices and advertising while still keeping the 5.0 S&Q rating. So the strategic group map for North America in the wholesale segment in year 20, by year 20 we had already blown away our investors' expectations, and we were at the top of our industry. We did so by gradually increasing our advertising over the period of time to nearly double from what we had started from, while keeping our retail support about the same and also keeping our prices relatively low compared to the competitive assumptions. Net revenues. As you can see by the chart here, we at FKD Shoes decided that the wholesale division would be our strong point, which proved to be a complete success to our company and to our shareholders. This was attributed to the large amount of advertising that we spent in every region while keeping our products within the $50 to $55 range. This also can be said about our advertising that we spent in the internet marketing. Our prices stayed around about the same range in every region, roughly $70 to $78, which kept us below the competitive assumptions from year 12 forward. Along with our inventory clearances, we believe that the advertising expense is what allotted us the ability to keep our prices lower than average, while reaching a large number of online consumers. Private label production, however, is one that we felt was not in our shareholders or FKD's best interest. So this was not our main focus. And again, as you can see by the chart, that's why there is little to no net revenues derived from that segment. Our prices and S&Q ratings for North America. Again, this chart represents the fact that we at FKD Shoes were able to keep our prices relatively the same in the wholesale division, while increasing our S&Q ratings. The strategy worked well in our industry as the amount of pictures were up. Industry with the amount of purchases were up, and we did not see the need to increase pricing. We mainly focused on quantity and quality rather than higher prices, which in effect made us the industry leader in the footwear industry. Our return on equity, as you can see here, is that our return on equity fluctuated throughout the simulation, with a high point in year 13 and a low in year 17. From this graph, I can point out from 16 to 17 is at the close of business in year 16, the competition had crowded the U.S. and Asian markets, and one company in particular had undercut our prices in those regions. However, this year was particularly bad for the competing industry as a whole. So to combat this, what we did was we reduced cost in training significantly. We added equipment in Europe and Asia. We cut our prices on some models. We increased our marketing in some areas that needed attention, and we changed delivery times from 3 weeks to 2 weeks. and also increased our bid for celebrity endorsements significantly. All these moves helped, however, in year 17, there was more competition in the private labor sector, and we realized that there was more revamping to do. So in response to the lower stock price and return on equity, what we did was we raised our dividends up to $1 a share, and also started buying back more shares. We actually bought back a lot of our outstanding shares at that year. We brought our facilities up to full operating capacity and decided that Asia was the only place that we would compete in the private label market. So our stock prices, all in all, these moves that we did paid off for the company and our stockholders. Our stock price has been on average over the past 10 years, $263.25. But since year 2015, the average has been $342.76, while topping out at the end of the simulation at $396.13. Our 3-year strategic planning exercise. So, with everything said, our projections were a bit high when we made the 3-year strategy. However, we still beat our projection on return on equity all 3 years in a row. It's highlighted in green here, including year 17, which I explained earlier. We kept our credit rating at an A+, and beat the expectations on our image ratings. When we completed the 3-year projection at the time, our stock price was the highest it had been, our return on equity was nearly 36%, and our earnings per share was high as well. Our targets were realistic in year 15, we thought, and we did not anticipate some of the market situations and competitions to do what they did. Like most companies, when setting a 3-year strategy, you try to be optimistic, and that is what our sentiments were. And we were not predicting lower earnings per share or lower stock prices. Since then, we thought. Then, though, we have come close to reaching our anticipated stock price that we had originally thought of. So our competitor analysis. Our 2 main competitors were really Team G and Team J, who are the ones that tied for second place at the end. Both these teams were good, did well. However, I'm going to focus more on Team G, and primarily, since they were on Team G, since they were our closest competitors throughout the game. And due to time constraints, I'm really only going to focus on North America plants. As I mentioned earlier, though, our prices remain relatively the same throughout the simulation. Team G did so as well, with a few exceptions, mainly in the wholesale and the internet divisions. So, Team G's market share was also close to ours throughout the game, although they did play around a bit with their private label brands, which is a strategy that we stopped in year 15 after our sales were at 0 and ending in year 14. Team G continued their private labels until year 16 and once again picked it back up in year 18, and this explains their jump in the market share as opposed to ours. So on competitive efforts, on the final round, I've highlighted some comparisons between us and Team G. First off, our prices. We both stayed relatively the same throughout the years. Next is our advertising, again highlighted there in green and yellow. Team G spent more on their advertising than we did in the last year, but as we'll see in the next couple of slides, we both upped our marketing expense year after year, beginning from 16 forward. Final thing I wanted to point out in this slide is that our celebrity appeal was up to 115 points when theirs was 0, which while we both spent roughly the same amount of money in that time frame. So here's the time series competitive efforts for our company. The green arrow shows where we dropped the private label area efforts after our bad year in year 14. But what I wanted to point out was the steady increase in advertising from year 16 forward, as you can see in the highlighted green. Here, wanted to point out there's Team G's time series competitive efforts throughout the years. But here I wanted to point out that they also increased their advertising from year 16 forward, and as well, and opted in for free shipping from 13 forward on the internet sales. But the free shipping possibly hurt them due to their low costs on their retail pricing on the internet. All in all, I believe that we were able to come up on top due to the steady prices in all segments and markets. We continued to offer high dividends while still having the ability to buy back our own outstanding shares. The prices, market shares, revenues helped keep us in the lead and greatly helped our return on equity. But the buyback and the dividends are what made our stock prices soar and us come up on top in the end. So, lessons learned, like I said before, the best lesson we could take out of this is the 3-year projection. In year 15, we were on top, and it seemed as though we could not be stopped. However, the sense of optimism quickly diminished when we saw our numbers in year 16. Although there was a major hit to most, if not all, companies that year, we definitely were overly optimistic. We thought that the markets would remain the same, and that we also thought that our numbers were pretty conservative while making our strategy. The lesson here is that although things may not be going in your favor, or may be going in your favor and moving steadily along, you cannot perfectly predict the markets. And even when you think your company can withstand anything and keep profiting, just like the old saying goes, sometimes the light at the end of the tunnel is really just a freight train coming your way. So thank you very much for Team F of FKD Shoes. And again, it's Derek Majak and Kevin Satterwhite.